The French economy is broken. France is on the brink of a financial catastrophe. It might seem like fear-mongering or an exaggeration, but if you do the math, France mathematically can never pay off its debts. And France is not the United States that has the global reserve currency. And if France falls, it is going to take down with it the rest of the European Union. Imagine if you are an investor in French debt. What are you going to do right now? You will massively start selling off all of your French debt because if it starts collapsing, then it is going to create a domino effect and will lead to a financial catastrophe. This is the biggest crisis France is facing since 1945. Raising money is essential for any country. If you can't raise money, then you can't grow like everybody else. This is how the global economy works. On one side, we have capital. These are the people with money. These are investors. These are with people with real wealth. And they're sitting down there and are thinking, how can we allocate our wealth so that we grow our wealth? That's how the world works. And they look around. They might be investing in companies, in businesses, in people, but most importantly, they could be investing in countries because countries have a very important resource, taxpayers. So you know that countries will pay off your debts and the risk of failure is significantly lower. So countries across the globe are competing to raise that money by providing the best environment for investors possible. So capital goes into countries such as France, and then France takes that money and invests it in economic growth. The economy grows, France makes more money, and France will pay off the investors who invested in the French debt. And if you can't borrow money, if investors are not willing to lend you money, then you will be in a financial crisis because all other economies are going to grow way faster than your economy. Of course, if you're a country with a lot of natural resources, then you don't need that debt. But if you're a huge country and your natural resources are not enough to fund your entire economy, you want to have a very good credit score. And France just lost its credit score. Some of the largest credit rating agencies downgraded France's credit score from AA to A+. This might seem insignificant, but this is huge because every time the credit rating agencies downgrade your credit rating, the cost of borrowing for you is going to rise, whether you're a company, an individual, or even a country. Just like your credit score, when you go and borrow a mortgage, when you go and borrow money to buy a car, when you go and borrow money for anything, the bank is going to look at your background. Are you the kind of person who will pay back his debts? Well, if you are not, then the bank is like, you know what? Risks with you are much higher than the average people, so we are going to charge you an extra percentage point. That extra percentage point might not seem like a big deal, but if you have borrowed that money for the next 10, 20, 30 years, it is going to add up to hundreds of thousands of dollars, if not millions of dollars. Depends on how much money you are borrowing. So if you look at the credit rating agencies, you will see that they have different ratings. If you have the highest ratings, that is literally like the prime rate, then investors would loan you money without thinking about it, knowing that you have the best rating possible and the risks with you are so minimal, so they are expecting a very low interest rate. So while everybody else is borrowing money at 5%, you can borrow money at 1%, maybe even lower than that. It literally depends on the financial situation of the world, but in general, you will be able to borrow money at a lower interest rate than everybody else. Everything that has an A is actually great, but the A levels also have different kind of levels. AAA is very different from A+ like France has right now. And France has been going down from AAA to as low as A+, and soon it might even lose its status as having an A rating and will go into B rating. And if you have B rating, that is already lower medium grade. Currently, the A+ is upper medium grade. So France is not even considered as the top countries to loan your money. France is already at risk of not being able to pay back its debts because it is at upper medium grade. And if this is going to continue, which it has been for the last couple of decades, then France can easily go into B and then C, and then the cost of borrowing money for France is going to be so huge that France will simply have to declare a default because there is no other option. And that's why it's extremely important to ensure that you have such a great credit score so that you can borrow money cheaply, grow your economy faster, and dominate the world just like the United States is doing. But let's be honest, the United States hasn't actually been really great with its credit score recently, but the US can afford that. The world's largest economy, the most powerful superpower existed in the world, and it has the global reserve currency. So yeah, France, sorry, you can't afford what the United States can afford. Please know your place. This is a joke, please don't take it personally. So the cost of capital for France is about to rise faster and faster because the risk and reward makes no sense. When risks are so high to loan you money, we are expecting a higher return. In fact, if you look at the French debt, you will find out that the rates for French debt has been actually rising over the last couple of years, especially since 2022. Well, of course, the debt for every single country has risen, but before 2022, in fact, since 2009 or 2010, France could borrow money at almost 0% interest rate. At some point, it was literally negative. Well, that was only possible from the European Central Bank, but from investors, it was also a very low rate of about 0.5% or less than 1% in general. Currently, it has risen to 3.3%, and as the credit score rating of France goes down, the cost of borrowing is going to rise. Even short-term debts are rising. The cost of 2-year French debt has risen from less than 0%, as you can see over here, to as high as 2%, and now it seems like it is going to rise to 2.5%, 3%. And because France has so much debt on one side, even a tiny percentage point is going to have a catastrophic impact on their debt payments. Because if you can't pay off your debts, imagine you are making, let's say, $100,000 and you have to make like $80,000 of debt payments. Even a $1,000 or $2,000 or $5,000 is going to have a serious impact on your budget because you are very tight on your finances and you're literally just paying off your debts by borrowing more money to pay off your previous debts. And if you're in that situation, even a single penny is going to count. The real question is that who holds the French debt? If we look at the French debt, which is one of the largest debts in the world, well, of course, it's not even close to the US debt, but that's the United States. We're talking about France at the end of the day. The question is, who is the biggest investor in French debt? Some countries have a lot of debt, but most of that debt is held by private investors or by the central bank. So it's not actually a big deal. But in this case, 50% of French debt is being held by foreign investors. And foreign investors, we are talking about non-banks, foreign banks, or foreign official investors. This could be countries, corporations, you name it. When you're a foreign investor in a foreign country, you're very skeptical. Even a small little trouble is going to cause you to think about, well, should I continue holding into French debt? Because it is there on the other side of the world. And maybe if France is on the risk of default, maybe it's time for me to sell my debts, get my money and invest it somewhere else, somewhere that is much safer than the French debt. But if there is going to be an oversupply of French government bonds in the market and there isn't strong demand on the other side because everybody looks at France as not the responsible person, financially at least, then you are going to have a debt catastrophe, just like Greece faced after the 2008 financial crisis. So that presents a very huge risk, because just the other half of the French debt is being held by French people, by French institutions, by French banks. Now, the problem is that if you compare it to other nations, only 30% of the United States debt is held by foreigners. In Italy, which is also one of the most indebted countries in the European Union, it's probably like the second or the third or maybe the fourth indebted country in the entire European Union. It has 28% of its debt held by public, or by foreign investors in this case, which lowers its risks. Even Spain, which is one of the most indebted countries of the European Union, has a 40% of its debt held by foreign investors. So foreign investors are very volatile. So France is in a completely different position than any other European country, or any country in fact, because most of its debt, at least 50% of its debt, is being held by foreign investors. Now, here's what makes it so different from other nations. Usually, when you have such a crisis, when a country can't pay off its debts, when a country is in a financial and a debt crisis, so this is the government and this is the central bank. And now the government can't pay off its debts. So what does the government do? The government wants to avoid a default. So suddenly you have the central bank who will start buying all of the debts of the government in order to prevent the government from a default. That's what happened in Japan. When Japan was in a financial crisis and it turned into one giant bubble and it crushed, the entire government was heavily indebted, you had the Japanese central bank interfering and buying all of these government bonds. It significantly devalued the Japanese yen, but it allowed, or it prevented, a default for the Japanese government. The real question here, can France do the exact same thing? Unfortunately, it can't, because France does not have an independent central bank. France is part of the European Union, and it also uses the euro. So France uses the exact same central bank like any other nation, or another 28 nations use the exact same central bank that France is using. So if the European Central Bank will intervene and will start massively buying off the French debt, it is going to cause massive devaluation of the euro. So by buying and saving France, the European Central Bank is going to put at risk the rest of the European countries. Do you think the rest of the European countries are ready to sacrifice themselves for the sake of France? Well, I don't think so. And that's why this crisis is so different from any other crises that we have seen in the past. The same crisis was in 2008 with Greece. But the difference between Greece and France is that Greece is a little tiny nation in the southern part of Europe that depends on tourism with a GDP of about $200 billion, while France has a GDP of $3.3 trillion and is the second largest economy in the entire European Union. So if Greece puts such a heavy pressure on the European Central Bank, just imagine for a moment how much pressure the French economy is going to put on the entire European Central Bank. Do you see the crisis that EU is facing? And here is the biggest problem, or this is what I call a complete disaster. The French GDP between 2023 or throughout 2024 has grown from $3 trillion to $3.16 trillion. So France added $110 billion to its GDP. So the French economy is actually growing. But the French debt has grown by $202 billion. So basically, the French debt, at least for now, is growing twice the fast than the size of the French GDP, which means that if you literally just do the math, France is about to go bankrupt. It's basic pure math, unless somebody is going to massively, or the European Central Bank is going to massively buy the French debt. Here are three stages of debt. The first stage is when you're borrowing money to invest and there is economic growth. So let's imagine that there is a country that does not have any basic infrastructure and it has like just people, it doesn't have roads. And you are the president of that country and you are going to borrow money and you are going to build roads. Suddenly, people in your country can travel among one another. Their productivity increases. They pay more taxes. You borrow money and you build an airport. And now people can fly into your country and they bring their capital. Tourism starts to rise in your country. So people pay more taxes. So when you borrow money to build that infrastructure, you're increasing the productivity of your nation and you are growing your economy very fast. So that makes sense in that case. So it is really great when you can use debt in order to grow the productivity of your country. That becomes a problem in the second stage, when you have borrowed so much debt that now you have to borrow money to pay off your previous debts. Imagine you have, let's say you make $100,000 and you spend $100,000, but you also have $100,000 of debt. Now you're just making $100,000 and you have to spend that money in order to survive, but you have an extra $100,000 of debt. So every single year you're changing your banks. You're borrowing money from one bank to pay off the second bank. Then when the time comes up, you're borrowing money from the third bank in order to pay the second bank, and so on and so forth. So essentially, in this case, you're not borrowing money to increase your productivity, but rather you are borrowing money to avoid a default. You're borrowing money to pay off your debts. So you are in this never-ending crisis. Now, the third stage of a debt problem is when you borrow money to pay off your debts, but it's simply not enough. So you can only borrow $100,000 because that's what the banks are going to offer you, but you have $120,000 worth of debt, and this debt has an interest. So your debt is growing every single year, but you don't have enough money to borrow to cover your debt. So mathematically, it's just a matter of time before you get into a real debt crisis and declare a default. And that's exactly where France is right now. So when I say that the French economy is in a complete disaster, this is not fear-mongering. This is not an exaggeration. This is basic, simple math. So the French debt is accelerating at rates that you cannot possibly comprehend. Right now, the French debt to GDP ratio is about 100, maybe 18%, somewhere around here. And by 2030, which is not that far, it's a few years from now, it is going to rise to about 130%. And with each year, it is going to keep rising and rising and rising. And suddenly the French government will be in a position where it's going to collect trillions of dollars in taxes from one side, from the French citizens, and then it will just pay the interest on its debts. Period. That's basically what the French government is going to turn to. And people are like, we're paying so much taxes. We're paying 50% of our incomes into taxes. Why don't we get social programs? Why don't we have better roads? Why don't we have better airports? Why don't we have better schools? Because if you want to avoid a default, you're going to pay all of that money to prevent a default to pay off your debts. The real question is, how can we fix this problem? Fixing this problem is not going to be easy. Let me make it very clear. I'm not a politician, so I can say this. This is going to be extremely brutal. First of all, you have to raise your retirement age. It is going to happen whether you like it or not. Currently, it is being proposed by the president, but the prime minister is rejecting it because this is a very unpopular option. People paid taxes for years, and now it's time for them to retire. You're going to tell them, you know what? Why don't you work for another 2 years and don't receive your retirement? Pay more taxes and receive less. Because at the end of the day, how many years you're going to live? There is a point where you are going to die. So if we take off 2 years out of your retirement, you're paying more in taxes on one side and taking less money out of the social security system. It is going to happen whether you like it or not. I would even say that they will raise the retirement age. Currently, it's about like 60 and they want to raise it to 62. They're probably going to raise it like to 68 or maybe even 70. There is a real possibility of that happening if you want to actually solve the French debt crisis. Secondly, raise taxes. France is one of the tax countries in the world. Like you pay the kind of taxes that you don't pay anywhere else. And they're going to raise these taxes even more. If you think that big, large corporations are going to do that, that's not happening. Either they will raise taxes on small businesses, or at the end of the day, they will simply raise it just like they always do on the average, normal employees. You're already paying so much taxes, so we'll tell you, we're only going to raise it by 2% or 3%, and that will raise enough money to simply postpone the crisis for another 5 to 10 years. And 10 years from now, they're going to tell you the exact same thing. We're going to raise it again. So it will happen whether you like it or not. Thirdly, cut social programs. France actually has some of the greatest social programs in the world. They are providing so much support to families, so much help to average people. You have some of the best, you have a very great insurance for every single French citizen, or maybe even every single French resident. And that's why most likely, in order to save money, they could cut some of these costs in order to be able to pay more of the debt and avoid a default. That's why you see that relying on the government is never a good option. And it's not just about France. This is coming literally for most countries, whether it's the US, Canada, the UK, France. France just one of the first countries to experience this problem because France simply messed up so bigly. So the only option that people have today is not to rely on the government, because the government sooner or later either going to raise taxes or will declare a default and will stop paying its debts. And if that happens, then the catastrophe is going to be much bigger. And that's why it doesn't matter where you are. Start investing, learn about investing, learn about how you can build wealth, learn about how you can become financially independent without relying on the government. Doesn't matter how much taxes you pay. After paying 50 years of payroll tax, 50 years later, they will tell you, you know what, we're going to raise your retirement age. And that's why if you want to know how you can build financial freedom through investing, then check out the first link in the description of this video.